Hello and welcome to the Business Standard Morning Show. I'm Vinu Sandhu. It's the 11th of August 2023 and here are the questions we will be answering today. How long will RBI's wait and watch posture continue? Is the autonomy of IIMs in danger? How are markets reading the RBI's inflation revision? And what is License Raj? The Reserve Bank of India kept the policy rates and stance unchanged on August 10th, despite a rate hike by the US Central Bank last month and the recent jump in food inflation. The RBI's Monetary Policy Committee unanimously decided to keep the repo rate at 6.5% for the third time in a row, and it increased its FY24 CPI inflation forecast to 5.4% from 5.1% earlier. The MPC also increased its second quarter retail price inflation projection beyond its comfort zone of 6%. In today's first segment, Bhaswar Kumar talks to experts to find out how long the RBI's wait and watch posture will continue.
While the vegetable price shock may reverse quickly, possible El Nino weather conditions along with global food prices need to be watched closely against the backdrop of a skewed southwest monsoon so far.
On August 10th, the RBI's six-member Monetary Policy Committee unanimously decided to keep the repo rate unchanged at 6.5%. Thus, the standing deposit facility rate remained at 6.25%, and the marginal standing facility rate and bank rate at 6.75%. This was the third time in a row that the MPC decided to press the pause button on repo rate hikes, with RBI Governor Shaktikanta Das saying that the pause had been done with preparedness to act if situation so warrants. By a majority of 5 out of 6 members, the MPC also decided to remain focused on withdrawal of accommodation. While leaving the cash reserve ratio untouched, the RBI said that banks would have to maintain a 10% incremental cash reserve ratio or ICRR from August 12th. The move is part of the RBI's efforts to drain excess liquidity from the banking system, following the withdrawal of the 2000 rupee currency note. The imposition of ICRR is a temporary measure which will reportedly suck out additional liquidity of over 1 trillion rupees. The RBI retained the GDP growth projection for the current fiscal year at 6.5%. Meanwhile, real GDP growth for Q1 of 2024-25 was projected at 6.6%. The MPC increased its consumer price index-based retail inflation forecast for FY24 to 5.4% from 5.1% earlier. While Governor Das said that the recent spike in vegetable prices would exert sizable upside pressures on the near-term headline inflation trajectory, he was hopeful that the jump was likely to correct with fresh market arrivals. Das also said that there had been a significant improvement in the progress of the monsoon and Kharif sowing in July. The MPC raised its projection for Q2 FY24 retail price inflation by a full 100 basis points to 6.2%. Beyond its comfort zone of 6% due to the spike in vegetable prices led by tomatoes. In the previous policy meeting, it had pegged Q2 inflation at 5.2%. The MPC pegged the inflation rate to be higher for the third quarter as well, at 5.7% against its previous projection of 5.4%. The projection for the fourth quarter remained the same at 5.2%. Meanwhile, retail inflation for Q1 of 2024-25 was projected at 5.2%. The latest MPC decision comes after retail inflation reversed its 4-month downward trend in June on surging food prices. The CPI-based inflation rate rose to a 3-month high of 4.81% year-on-year in June, against 4.31% in the previous month. Meanwhile, food inflation rose sharply to a 3-month high of 4.49% in June, from 2.96% in May. Against this backdrop, how long will the RBI's wait and watch posture continue?
To my mind, the wait and watch policy will continue through the course of the year. The reason being that since the RBI is targeting inflation, and inflation appears to be very whimsical, one will have to wait and see until the time it stabilizes before there can be comfort drawn that inflation is really under control, and the RBI can decide to probably consider a change in the overall policy direction. While the RBI has admitted that inflation is going to be at a higher level, maybe crossing 6% for 2 months, July and August, they do think that correction in terms of food prices, especially on the vegetables front, because these are seasonal shocks which have come through, will help to restore inflation to less than 6%. So I don't think there is a case of one expecting the RBI to increase rates in this particular phase. But definitely the fact that inflation is going to be above 6% in the second quarter is some reason for us to believe that the hawkish tone is going to persist for the rest of the year.
We expect the pause to continue till the end of this fiscal year, and there are two reasons for that. One is that the rate hikes that RBI has done so far, they have a lagged impact on the economy, and that impact is still playing out, and the peak impact is yet to play out. So they have to watch for how it impacts the economy. Second, I think, is the inflation scenario is a little uncertain because of the food inflation issue, and we'll get more clarity on that after the monsoon season is over, after the El Nino effect, whether how strong it is. We are clear on that, whether it has impacted some of the other countries in Asia from which we import edible oil, etc. So there are many things that to look out for. I don't see a rate hike happening now. I think unless I think inflation becomes a big worry, which is not the scenario that RBI is penciling in, nor are we penciling in.
Also, what is the key takeaway from the latest MPC meeting?
It's been a fairly hawkish tone. I would say hawkish not because of anything done to the repo rate, but first you have increased the inflation forecast, which makes a big difference. And second, I think this incremental CRR is something which is, of course, very of temporary in nature, but the signal in sense is that, look, I don't want to increase the repo rate right now. So therefore, what I'll do is that there is surplus liquidity, there is potential high inflation. I won't touch the repo rate because that becomes a permanent increase which takes place. I won't go in for an open market operation, but I'm going to curb the amount of liquidity which can be used by banks, which could be having potential inflation impact. So I think hawkish note is what I would take away from this particular policy.
And finally, what will be the key areas of concern for the RBI going forward?
Now, vegetable inflation is extremely volatile. I'm not too worried about it. Even the central bank can look through it because it is going to come down within 1.5 to 2 months. But it's the cereals where I think both global and domestic factors are at play, where inflation is in double digits for quite some time now. I think what happens there is more of a worry. The central government has started intervening in the system, started selling at lower prices. How all that plays out, I think, is also the central bank will be watching that too. So I think the worry is more on the food grain part of food.
To conclude, the RBI is likely to continue with its wait and watch policy through the course of the year, while also maintaining a hawkish tone during that period.
Soaring inflation is not a good news for the government, given that an election is just a few months away. Price rise will be an issue on which the opposition will target it. Meanwhile, the government is also facing opposition over a bill which the Parliament passed recently. The Indian Institutes of Management Amendment Bill 2023 is now headed to the President's desk. It is being alleged that this bill will dilute the autonomy of these premier institutes. The government's contention is that it will bring more transparency in the IIMs. So what is this bill all about, and will it really dilute IIM's autonomy? Ayush Mishra finds out.
The Indian Institutes of Management, revered as the top institutes for management studies in India, are in the news now. The Rajya Sabha on Tuesday passed the Indian Institutes of Management Amendment Bill 2023 to amend the Indian Institutes of Management Act 2017. The 2017 IIM Act had provided the institutes a higher degree of autonomy over their functioning with a very limited role of the government. The Board of Governors of each institute comprised 19 members, including one representative each from the central and state governments. The new IIM Amendment Bill 2023 entrusts the President of India with the management accountability of the institutes. The bill appoints the President of India as the visitor to all the IIMs. As per the proposed changes, the visitor will have powers to conduct audits and even appoint or remove the chairpersons of the Board of Governors and Directors. So does this mean the IIM Amendment Bill 2023 will erode autonomy of the premier institutions?
Bill actually, kind of appoints the president as a visitor. That's what the biggest change that has happened. The fact that all IIMs were pretty much independent with no, overarching body governing them on a day-to-day basis is the biggest change that this bill has been amended. So will there be a shift in terms of the autonomy of IIMs? I think there will be. Is it a good or a bad thing? I guess if it's balanced, it will not be very bad because, it's always good to have someone who is probably asking even us a question on what are we doing, how are we doing it. But the other change that the bill has actually, mentioned is about the visitor having, authority on deciding who the director of the IIMs would be. And I think that is going to be a very big change against what it was till so far.
20 IIMs across the country enjoy the status of institutions of national importance. With approval of the new bill, the National Institute of Industrial Engineering in Mumbai will get the status of IIM, making it 21st IIM called IIM Mumbai. The visitor may appoint one or more persons to review the work and progress of any institute and hold inquiries into the affairs thereof. This, according to some, virtually gives the government a veto power in the critical appointments. The bill's implications have sparked debates within academia and beyond. Critics argue that increased government intervention might compromise the autonomy that IIMs have traditionally enjoyed. They fear that centralized appointment processes and heightened financial oversight could potentially hinder the institute's functional agility. Speaking to Business Standard, former Chief Executive of Procter & Gamble India, Gurcharan Das explains how the possible loss of autonomy may impact the performance and quality of IIMs.
If you lose autonomy, then you can see how the other government institutions, the education institutions, forget the IIMs, but look at what's happened to our best colleges that were once, matters of great pride. And we all know them, so I won't mention the names, but they've all become mediocrities because there is a governments play safe, and you need to pursue excellence. You have to have outstanding people, and safe administrators are not the ones who are going to bring that.
Some older IIMs have also alleged that they were not part of the consultation process before the amendments were laid out. While they are skeptical about the increasing role of government in management, the new institutes are apparently in agreement with the amendments proposed. Das believes the new bill will make the boards in new IIMs stronger than before.
Well, it's also a function of the high-performing institutions and the low-performing institutions. You can argue that the low-performing institutions, some of the new institutions, they need time to get their standards up. And they need more oversight. The boards there need to bring, you need a stronger boards in many cases, more visionary boards. And this often takes time. The old institutions they've seen how government control erodes autonomy. And they worry that standards will go down further rather than rising up with government control.
The IIM Amendment Bill 2023 focuses on increasing the accountability and governance in the premier institutes. While the bill's provisions aim to enhance IIM's overall performance by appointing the President of India as visitor, the possibility of autonomy dilution remains a lingering point of concern.
In March this year, at least 12 students of IIM Indore were offered an annual package of 1.14 crore rupees. Well, soaring inflation will not be a worry for them, but it is for others. Domestic markets fell up to 0.4% in Thursday's trade after the RBI revised inflation projection for FY24 amid a sharp rise in food prices. The introduction of incremental cash reserve ratio also kept sentiments in check. With the inflation projection above the comfort zone, will the delay in rate cut hopes keep the bears in control in the near term? Lavisha Darat explains.
The upward revision in Reserve Bank of India's FY24 inflation projection, along with imposition of incremental cash reserve ratio, spoiled investors' mood on Thursday, August 10. Frontline indices, the S&P, BSE Sensex and Nifty 50 fell 0.4% each, led by losses in banking and financial names. In line with market expectations, the RBI Monetary Policy Committee maintained the status quo for the third consecutive time, keeping the lending rates unchanged at 6.5%. However, given a sharp spike in vegetable prices, the central bank turned more hawkish to revise inflation projection to 5.4% for FY24 from 5.1%. Governor Shaktikanta Das further warned that a substantial increase in headline inflation can occur in the near term amid uncertainties on domestic food price outlook and possible El Nino conditions in August and beyond. This, analysts believe, will hold policy rate on the higher end for long, keeping markets volatile in the near term.
The market would correct even another 3-4% in the short term, and RBI would not cut down nor it would hike for next 2-3 months. It would cautiously watch one single factor, which is the crude oil price. Now the crude oil price has hit a 9-month high, and earlier the crude oil price used to be down on year-on-year basis even 40%. Now it is just about 7-8% down on year-on-year basis. So this single factor can disrupt the the projection of inflation and the outlook for the monetary policy.
That apart, in order to absorb excess liquidity, the RBI asked banks to maintain incremental cash reserve ratio of 10% temporarily. Apurva Seth of Samco Securities said that this measure could prove to be sentimentally negative for banking stocks in the near term, as they will not earn any interest on funds kept under ICRR. He underlined that the RBI move may pave the way for healthy correction for overall markets, including banking stocks. If Bank Nifty fails to hold above the 44,500 mark, then there is a chance of a fall till 43,500. Against this, how should investors approach market going ahead?
Up to 5 to 10% cash, 5% gold ETF, up to 30-50% in the large cap, and then balance in small and mid cap where valuation comfort is there. Definitely, they will create a good wealth provided the valuation comfort is there. So this is the time to be very, very cautious.
Overall, analysts believe that higher inflation reading could keep domestic equities in check and suggest investors adopt a stock-specific strategy. On Friday, August 11, markets will react to US July inflation figures and India Inc.'s June quarter results.
He's making plans for an early retirement. Business Standard.
Stocks of some domestic electronic manufacturing firms have been on the rise since the government announced the move to restrict the import of laptops, tablets, and personal computers. But the move has also invited criticism, with experts describing it as the return of the license Raj. But what is license Raj and why do people dread it? Vasudha Mukherjee has the answer.
License Raj was a play on the term British Raj. It is a pejorative used to describe a system of government that adhered to strict rules, regulations, and control over the Indian economy. Under this system, businesses in the country required licenses to operate. Businesses sometimes had to receive approval from up to 80 agencies before they were granted licenses to produce. The state would decide what was produced, the quantity of production, market price, and even had a say in the source of the capital used in production. The government also restricted firms from conducting layoffs and closing factories. The system worked on the belief that India needed to rely on its own markets, become self-sustaining and self-sufficient. Import substitution was at the center of this policy. However, under the system, those with connections and wealth had more chances of building powerful businesses. Moreover, as the government controlled production and protected workers, businesses lacked competitiveness and many produced low-quality products. In 1991, as the country was hit by an economic crisis, the World Bank and IMF pressed India to fundamentally transform the country's economic structure from centrally planned to market-driven. This was part of the requisites for India to receive a substantial loan from the international bodies that could take them out of its crisis and stabilize the economy. The government also had to pledge India's gold reserves as collateral to the Bank of England and the Union Bank of Switzerland. Then Prime Minister P.V. Narasimha Rao onboarded Manmohan Singh as his finance minister to help launch India's 1991 economic reforms. Regulations began to relax and License Raj came to an end. This launched a whole new generation of entrepreneurs. Freedom from the regulations allowed more people to seek out entrepreneurship, and it changed the landscape drastically as competition replaced connection. Indian businesses also got the opportunity to compete globally. It is no wonder that businesses now would be worried when the term License Raj is thrown around, as it serves as a reminder of a structure where power lay with the few.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Global laptop makers like Apple and Dell want the new import licensing norms to be delayed by 9 to 12 months. Well, that's all for today. For more news and analysis, please log into our website business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.